Welcome to Thoughts on the Market. I'm Lindsay Tyler, Morgan Stanley's lead investment-grade TMT credit research analyst. And I'm here with Michelle Wang, head of investment-grade debt coverage in global capital markets. On this special episode, we're recording at the Morgan Stanley Technology, Media, and Telecom Conference, and we will discuss the latest on the technology space from the fixed income perspective. It's Thursday, March 6th at 12 p.m. in San Francisco. What a week it's been. Last I heard, we had over 350 companies here in attendance. To set the stage for our discussion, technology has grown from about 2% of the broader investment-grade market about 2 decades ago to almost 10% now, though that is still relatively a small percentage relative to the weightings in the equity market. So can you address 2 questions? First, why was tech historically such a small part of investment grade? And then second, what has driven the growth since?
Technology is still a relatively young industry, right? I'm in my 40s, and well over 90% of the companies that I cover were founded well within my lifetime. And if you add to that the fact that investment grade debt is by definition a later stage capital raising tool, when the business of these companies reaches sufficient scale and cash generation to be rated investment grade by the rating agencies, you wind up with just a small subset of the overall investment grade universe. The second question on what has been driving the growth, twofold. Number one, the organic maturation of the tech industry results in an increasing number of scaled investment grade companies. And then secondly, the increasing use of debt as a cheap source of capital to fund their growth. This could be to fund R&D or CapEx or, in some cases, M&A.
Right, and I would just add in this context that my view for this year on technology credit is a more neutral one, and that's against a backdrop of being more cautious on the communications and media space. And part of that is just driven by the spread compression and the lack of dispersion that we see in the market. And you mentioned M&A and capital allocation. I do think that financial policy and changes there, whether it's investment, M&A, shareholder returns, that will be the main driver of credit spreads. But let's turn back to the conference and on the, I mentioned investment. Let's talk about investment. AI has dominated the conversation here at the conference the past 2 years, and this year is no different. Morgan Stanley's research department has 4 key investment themes. One of those is AI and tech diffusion. But from the fixed income angle, there is that focus on ongoing and upcoming hyperscaler AI CapEx needs. There are significant cash flows generated by many of these companies, but we just discussed that the investment grade tech space has grown relative to the index in recent history. Can you discuss the scale of the technology CapEx that we're talking about and the related implications from your perspective?
Let's actually get into some of the numbers. So in the past 3 years, total hyperscaler CapEx has increased from $125 billion 3 years ago to $220 billion today and is expected to exceed $300 billion in 2027. The hyperscalers have all publicly stated that generative AI is key to their future growth aspirations. So why are they spending all this money? They're investing heavily in the digital infrastructure to propel this growth. These companies, however, as you've pointed out, are some of the most scaled, best capitalized companies in the entire world. They have a combined market cap of $9 trillion. Among them, their balance sheet cash ranges from 70 to 100 billion per company. And their annual free cash flow, so the money that they generate organically, ranges from 30 to 75 billion. So they can certainly fund some of this CapEx organically. However, the unprecedented amount of spend for Gen AI raises the probability that these hyperscalers could choose to raise capital externally.
Got it.
Now, how this capital is raised is where it gets really interesting. The most straightforward way to raise capital for a lot of these companies is just to do an investment-grade bond deal. However, there are other more customized funding solutions available for them to achieve objectives like more favorable accounting or rating agency treatment, ways for them to offload some of their CapEx to a private credit firm, even if that means that these occur at a higher cost of capital.
You touched on private credit. I'd love to dig in there. These bespoke capital solutions.
Right.
I have seen it in the semiconductor space and telecom infrastructure. But can you please just shed some more light, right? How has this trend come to fruition? How are companies assessing the opportunity? And what are other key implications that you would flag?
Yeah, for the benefit of the audience, Lindsay, I think just to touch a little bit more, some
yes.
definition
And
around
some
what we're
context.
talking about.
Yes.
So I think what you're referring to is investment grade companies doing asset level financing, usually in conjunction with a private credit firm. And like all financing trends that came before it, all good financing trends, this one also resulted from the serendipitous intersection of supply and demand of capital. On the supply of capital, the private credit pocket of capital, driven by large pockets of insurance capital, is now north of $2 trillion, and it has increased 10x in scale in the past decade. So the need to deploy these funds is driving these private credit firms to seek out ways to invest in investment-grade companies in a yield-enhanced manner.
Right. And typically we're saying 150 to 200 basis points greater than what maybe an IG bond would yield.
That's exactly right.
Yeah.
That's when it starts to get interesting for them, right? And then the demand of capital, the demand for this type of capital, that's always existed in other industries that are more asset-heavy, like telcos. However, the new development of late is the demand for capital from tech due to two mega trends that we're seeing in tech. The first is semiconductors. Building these chip factories is an extremely capital-intensive exercise, so creates a demand for capital. And then the second mega trend is what we've seen with the hyperscalers and generative AI needs. Building data centers and digital infrastructure for generative AI is also extremely expensive, and that creates another pocket of demand for capital that private credit conveniently kind of serves a role in.
Right.
So, look, I think we've talked about the ways that companies are using these tools. I'm interested to get your view, Lindsay, on the investor perspective.
Sure.
How do investors think about some of these more bespoke solutions?
I would say that with deals that have this touch of extra complexity, it does feel that investor communication and understanding is all important. And I have found that some of these points that you're raising, whether it's the spread pickup and the insurance capital at the asset managers, and also layering in ratings implications and the deal terms, I think all of that is important for investors to get more comfortable and have a better understanding of these types of deals. The last topic I do want us to address is the macro environment. This has been another key theme with the conference and with this recent earnings season. So whether it's rate moves this year, the talk of M&A, tariffs, what's your sense on how companies are viewing and assessing macro in their decision making?
There are three components to how they're thinking about it. The first is the rate move. So the fact that we're 50 to 60 basis points lower in treasury yields in the past month, that's welcome news for any company looking to issue debt. The second thing I'll say here is about credit spreads. They remain extremely tight, speaking to the incredible kind of resilience of the investment grade investor base.
Right.
The last thing I'll talk about is, I think, the uncertainty, because that's what we're hearing a ton about in all the conversations that we've had with companies that have presented here at the conference.
From my perspective, also the regulatory environment around that M&A, whether or not companies will make the move to maybe be more acquisitive with the current new administration.
Right. So until the dust settles on some of these issues, it's really difficult as a corporate decision maker to do things like big transformative M&A or take your company public when you don't know what could happen, both from a market environment and, as you point out, regulatory standpoint. The thing that's interesting is that raising debt capital as an investment grade company has some countercyclical dynamics to it, because risk-off sentiment usually translates into lower treasury yields and more favorable cost of debt. And then the second point is when companies are risk-averse, it drives sometimes cash hoarding behavior, right? So companies will raise what they call, rainy day liquidity and park it on balance sheet just to feel a little bit better about where their balance sheets are.
Yeah.
Make sure they're in good shape.
Deal with the maturities that they have right here in the near term.
That's exactly right. So I think as a consequence of that, we do see some tailwinds for debt issuance volumes in an uncertain environment.
Got it. Well, appreciate all your insights. This has been great. Thank you for taking the time, Michelle, to talk during such a busy week.
It's great speaking with you, Lindsay.
And thanks to everyone listening in to this special episode recorded at the Morgan Stanley TMT conference in San Francisco. If you enjoy Thoughts on the Market, please leave us a review wherever you listen and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.